Hi, this is Charles Kelly, Money Tips. Well, you may have heard in the news this week that interest rates, base rates set by the central banks have gone up in the US, the EU Central Bank and the UK Bank of England, all on pretty much the same couple of days this week. So what will that do to you? How will that affect you as a saver, as a borrower, and how will it affect the economy? Listen now, and also while you're there, if you do like this content, please like and share, and do feel free to join me on my free money financial management webinar next Wednesday at 8 p.m. And I'll put the link up below for you to join. Now, as I said, central banks in all three big central banks in the West have put up base rates. In the US, they went up by 1/4, then 0.5% in the UK and the EU. And they've increased this to combat, of course, inflation, rising prices. Even though inflation seems to be coming down a bit and settling, they're still going in hard. And this to borrowers and to most people who are affected by it is like a punch in the solar plexus or a kick in the you know what to borrowers. Let me tell you, because interest rates now at 4% in the UK, the highest they've been for years and years and years. I mean, a lot of young people might not remember such high interest rates. I'm an older person. I do remember these high interest rates, and I know how high they went. I remember when people were lucky and thought themselves lucky to get a 10% fixed interest rate mortgage. So yeah, I know how this is going to affect. But inflation, as you know, is really a sustained increase in the cost of living, in the general price of goods. And we've seen this over the couple of years, the events of the last couple of years, in particular, the war in Ukraine. But I think a lot has got to do with the money printing on an industrial scale by the central banks, this quantitative easing, which has devalued the value of our fiat currencies. And it means that everything is going up. And although they're saying we're not really in recession, inflation is under control, we know that food prices are still going up by 15 to 20%. And I've seen some foodstuffs go up by 50%. So that's why they're increasing higher rates. And this will have a particular impact on borrowers. There are hundreds of thousands of borrowers coming off of fixed rates in the UK. They are going to really be hit, because if you're fixed on a 3, 5, 2-year deal now at say 2%, 2.5%, and then you come up to a new deal, and before this interest rate rise, you would have been on a deal of over 5%. Now we don't know where it will go. So that could double people's payments on their residential mortgage or on their buy to let. And if you're coming up to a buy to let renegotiation for a new rate, you're going to get a shock as a buy to let landlord. But what if the lender says, well, sorry, you don't qualify because you can no longer afford this mortgage because the mortgage is nearly as much as the rent, or maybe more than the rent. So then what do you do? Well, I'll come on to that in a second. But in conclusion, the recent interest rate rises seem to be a sustained attack on inflation by the central banks, even though I think they caused it. And this is going to affect hundreds of thousands of borrowers, maybe millions of borrowers across the world. I think in America, they tend to have longer term fixed rates, like 30-year fixed rates. In the UK, we tend to have 2 and 5-year fixed rates. And, it's already having an effect on the housing market. We've seen this week another lender saying that the housing market has dropped, has come down for the 5th month in a row. I think this time by 0.6%. It's only growing year on year by about just over 1%. And that's, more than half of what it was the previous year. So we're already seeing this effect. And I talked to one bank the other day and said mortgage deals have really gone down, very, very quiet. So we know what's happening in the market. So what can you do if you're experiencing difficulty in keeping up repayments on your mortgage, or you're in arrears, or you're just worried about things? I'm going to give you 4 quick tips. First of all, talk to your lender. Don't sort of bury your head in the sand and hope that things will all go away, because it won't. Don't wait for them to start contacting you about arrears and sending you letters. So rather than waiting for them, talk to your lender and let them know the situation. They'd much rather hear from you than have to chase you. Secondly, you can ask the lender, could they renegotiate things for you? Now they might be saying, well, to get on this new fixed rate, you can't afford it. Sorry, you're not in that club. But you can say, well, look, I can't afford this. So the government have told lenders to be more flexible. So maybe you could say to the lender, well, I'm on a repayment loan where I'm paying back capital and interest at the moment. I want to temporarily switch to an interest only deal for the time being until things start settling down with rates. So you can do that. Now, many buy-to-let borrowers are already on an interest only. If you're on a repayment loan, it's a bit more difficult to switch, but you can talk to your lender about that if you're in problems. In the past, you could easily switch between the two. Now they've got a bit more cautious. So try and talk to them, see if you can even negotiate a rate with them. Say, look, okay, my buy-to-let deal doesn't quite match the criteria, but I've got other income here to make that up. And certainly banks like Metro Bank that I was talking to today are prepared to take into account your income other than the rental income from that particular property. If you can subsidize it, they'll put you onto a fixed rate deal. So they are more flexible than some of the lenders, but the government have told them all to be flexible. Thirdly, you could set up a plan to reduce the higher interest rate debts that you've got. Now, this includes credit cards, finance, payday loans and Klarna and all that sort of rubbish. Get rid of those so that you can pay your mortgage. Now, people say, well, how can I do that? Well, start paying it off, start paying extra to clear them. Or if you've got savings that you can afford to put, you don't need for emergencies, you could maybe pay off that credit card debt because you're probably earning next to zero on your savings. Even though interest rates have gone up, savers should be benefited, but they're not. The banks are screwing people. So if you've got savings sitting there earning less than 1%, but you're paying credit cards of 20, 30%, then it doesn't make sense to have that savings there earning nothing while you're paying 25, 30% on your credit card. So maybe pay that off. So that will save you hundreds of pounds per month. And finally, talk to, if you're really in trouble and you've gone beyond the point of no return and you can't do anything, then it might be time to talk to a regulated debt advisory firm or a charity to see if you can renegotiate your debts with your creditors. And you can try and do this yourself, but it sometimes helps to have a company behind you to advise you. Now, they're all regulated by the FCA. Don't go to any sort of cowboys. Go to regulated firms. There's not that many in the UK, and I'm sure in your wherever you're listening to, they might have similar things. So those are the 4 things you can do. Talk to your lender, ask them to give you a better rate or switch to interest only, set up a plan to reduce your higher interest rates, debts like credit cards, and finally, if you're really in trouble, talk to a regulated debt advisory firm. If you don't know any, talk to me and I'll put you on to somebody. Now, if you want to learn more about controlling your finances and getting yourself to a situation where you never have this problem again and you're worried about things, then look at my 3-step money management plan in my free training webinar this Wednesday at 8 p.m. And I'm going to give you 3 steps to get control of your finances and spending so that you can not only survive but thrive in any recession or even a depression. So join me next week, 8 p.m. You have to register, so click on the link, give us your name and email address, and we'll remind you when that webinar is due to start next Wednesday at 8 p.m. Thanks for listening.